Right, okay. So today's webinar is about, as mentioned, investing in the UK real estate market specifically. And it's more a question of, is it still attractive? It's something that's been coming up in conversations in the last 5 or 6 months. Obviously, the UK has been in the news for different things. Last year, we were changing prime ministers every 2 weeks. Obviously, interest rates, things like that. Brexit, always a big thing that's been in the news for a number of years. So that's what we'll look at today. Is it still a good, attractive story, or has its day finished? So I think most of you already know me, but for those who will be watching the recording later, a brief introduction about me. So I've been in the UAE for 22 years now. I'm part of the Lawson's International Advisory Network of advisors. So we work as private consultants with a regulatory umbrella. We cover everything from stocks, property, structured notes, insurance, citizenship by investment, a full spectrum service for all things to do with personal and family finance. And of course, most importantly, a husband, a father, and an avid sci-fi fan. So the UK has long been known as a friendly market for overseas investors. And its real estate sector has a track record of stability, which goes back centuries. Before we look at the market in a bit more detail, I'd like to show you some of the facts and figures about the UK, and then we'll go on to what options are actually available for non-residents. So obviously the bare bones and stats of the UK, the current population is around 67 million. GDP is still quite high. It's not the highest in the world, but it's certainly not the lowest. And still in the HDI, which is the Human Development Index top 20. I think it's 18 at the moment, which is pretty fierce for competition because you've got a lot of countries in this region as well, and some of the smaller, wealthier states in Europe, which attract very high net worth individuals. But its GDP is still fairly respectable, I think. And one interesting fact that some of you may not be aware of is that the pound is actually the oldest continuously used currency. It's been around for just over 1,200 years. It's also still the 4th most traded currency in the world and the 4th most held currency in reserve in the world. It's the legal tender of 9 territories, not just the UK itself. And something that the UK is more famous for, particularly if you're in any kind of technical industry, is the UK is very high in the innovation space globally, across different sectors from industry to technology. But over the last few years, and especially since the pandemic, we've seen a lot of sensational press from the UK, as I mentioned, changing prime ministers, Brexit, divorce disputes with the EU. And so the question is the UK still attractive for non-resident investors? Real estate investing, wherever you go in the world, has to be backed up by simple supply and demand economics. If there is no demand to buy or rent, you're going to struggle to make your investment work wherever you are. If developers aren't needed to construct to meet demands, they tend to shrink and perhaps even disappear. So where does the UK fit in this basic economic truth? Well, as you can see, the National Housing Federation, as recently as last year, was saying that the UK needs over 340,000 houses to be delivered in England alone, not the whole of the UK. And of that, there should be a number of affordable houses. As many are aware, housing in the UK is quite expensive, particularly in London, but also in a lot of the other cities. And it's pricing a lot of the locals out of the market, really. If we look at the deficit of house builds just for last year alone, we can see that that's over 100,000, which is quite a significant number that needs to be built. And bear in mind, this is in a country that has limited space and often quite tough planning and development laws. And if we go back a number of years, we can see that while they have increased the amount of housing that needs to be built, we've almost every year had a deficit of between 50 and 150,000 homes being built. This has created tremendous pressure on the rental and on the buying market, which of course means the answer to the question is yes. From an economic perspective, the UK has a strong supply and demand story. Despite the pandemic, despite Brexit, despite the interest rates and the slumps that have happened, the real estate sector is still a very important one for the UK economy. The economic realities of supply and demand simply support landlords and investors. The turnover and people employed in the UK real estate industry have actually increased since the pandemic, and it remains a multi-billion-pound sector. However, every rose has its thorn, as the song goes, and these days, the UK, like most countries, has been suffering from very high inflation, which has resulted in the Bank of England raising interest rates, and we're seeing predictions and pricing in the market anticipating further increases, at least for the next year, possibly 2 years at most, before a steady decline, which this graph shows here. Now, for people who already own property in the UK, especially for homeowners, and this has been quite a big blow if they've not budgeted for this. And one thing I see almost consistently is when people take financing for property, they tend to max out as much as they can and go right to the edge of their budget. And they don't think about, well, what happens if interest rates rise? So people who've been buying in the last, let's say, 4, 5, 6 years or so, have really been hit very hard if they've not managed their money well. And of course, some of them may even lose their homes. But there's always a silver lining to every cloud. And I think if you're looking at buying in the UK now or investing in the UK now, and you can manage inflation and the cost of borrowing, then you're actually looking forward to, in the near future, seeing your mortgage go down. So the cost of borrowing will reduce for you, which means, of course, that you'll have more disposable money and income. And we're not looking at a massive correction in the market. In fact, house prices have just risen again recently, and probably will continue to do so, although things are cooling off, which is exactly what the central bank wants. So it could actually be a very good time to consider the UK, as with any developed market where interest rates are very high right now, because you'll have breathing room later on. So to come to the crux of things, what are the options for you as a non-resident looking at the UK? Typically, we break investments up into time. So we look at short-term and long-term. In real estate, you might be looking to save up for a deposit for a property, which may take a couple of years, depending on your budget and the kind of property you're looking to invest into. And in that time, you may want to invest the money, but you can't find anything that you're happy and comfortable investing in. Well, these days in the UK, there's an answer to that, which is property-backed loan notes, which I'll go into in a bit more detail. And these are typically 1 to 2 year vehicles, which are issued by developers. They're private contracts structured a bit like bonds. And then, of course, you've got traditional property, which is you go in, you buy the property with financing or outright, and you're buying and holding, you're relying on a tenant to come in, pay your financing for you, and create stable income. So to come back to loan notes, one of the things that's very attractive about loan notes is they are lower entry levels than buying property. Typically, these days, you'll be looking at around 30% deposit to buy a property in the UK, depending on your credit history, where you live, financing requirements, etc. And given the average house price is north of 250, that can mean quite a substantial amount of money to come up with. And so for some people, while they're saving that, they still want their money to be doing something for them, to be working, and they like property. So developers are issuing these loan notes to help you get to that goal faster. They are essentially legal contracts, very similar to a bond, but they're not transferable or resellable typically, and they run for a fixed term, which is 1 to 2 years. Best of all, they are outside of capital gains tax. So if you're a non-resident and you invest into loan notes in the UK, you're tax-free, as long as you are resident in a tax-free country, I should add. So if you're in the UAE, like I am, it's tax-free. If you're in the Netherlands or Germany or somewhere else, then you pay the tax according to the local laws there. Things to look out for, though, with loan notes is, most importantly, the company track record. As with any lending, if a bank lends you money, they're not going to lend money to you if they don't think you can pay it back, or can't pay it back, sorry. So it's important to make sure that you're working with reputable partners. For the loan notes that we work with, for example, we only pick companies that have got at least 10 years track record, ideally 15 to 20. We also look, most importantly, for a perfect payment track record. We don't want to see any gaps, any missing payment records or delays for any reasons at all. And we also look at things like security trustees. Now, a trustee should be overseeing the whole process and legally is able to take control of the company if they default, sell the company's assets, and pay back you, the investor, from the loan note. Typically, these loan notes are issued by developers that are building large-scale projects, sometimes commercial projects where they need cash quickly, and going to the banks right now especially is not that attractive for them. Sometimes it's projects that they then sell on to institutional investors with very large margins. Of course, we've got the most traditional way of owning property, which is direct ownership. And that falls into two broad categories, leasehold and freehold. I appreciate most people know what these are already, but for the sake of the recording, I'll just quickly explain that leasehold is where you own the actual unit itself, typically an apartment, but sometimes a house itself or a villa, but you don't own the land. Whereas freehold, of course, you own the whole thing. The whole package is yours. The beautiful thing about freehold property, and with leasehold property to a lesser degree, is it's a tangible asset. It's very easy to understand. It's psychologically very comfortable. You can sit there on a Sunday afternoon having a cup of tea, reading a paper, talking with your family, and in the back of your mind, you know you've got something that is real. You can touch it. You can go and see it if you want to. And of course, there's something that people will always need, which is a place to live. These days, things are very, very easy to do. They're much easier than they were in the past. And certain segments of the market are geared towards catering to the non-resident investor. So there are many ways of managing properties remotely with a full tiered service from the time you select the kind of property you want through to finding financing, to managing, and of course leasing as well, and even things like filing taxes, which I'll touch on very briefly as well. And of course, with carefully considered financing, you can boost your return significantly. One thing we see a lot of when we see property is the estimated returns, the return on investment. And a lot of the time they put the return as the value of the property, and then they express it as a percentage. And that could be 4, 5%, 6%, whatever it is. And some might say, well, that's quite low. But when you consider that you've only put perhaps 30% down on the property and you're getting 6% on the 100%, your 6% becomes a lot less, a lot more, so 2-3 times, etc. Things to look out for, though, with direct ownership. Now, I could talk about things like location and all of that, you know, studying the local market and making sure you're in the right place. But I think those things go without saying. The most important thing to think about is emotions, actually. It's easy to get caught up in hype. It's easy to look at properties from an investment perspective and say, well, I don't particularly like this one, or that's not something that I would live in, so therefore it can't be a good investment. It's important to remember that you have to detach yourself and look at what the market wants. We're talking about creating wealth sustainably for the long term, not buying and selling and flipping. The UK works very well when you buy and hold. So detaching your emotions, as you would with stocks and shares as well, very, very important. And of course, you need to decide what suits you best between off-plan and existing property. Off-plan is extremely popular in the UK, but quite limited compared to other markets. There are some very good options available. There are even developers which will allow staggered payments of your 30% deposit, and then will help you to get financing as well, so that it breaks it up a bit and makes it manageable. And of course, with existing, you've got a whole nother series of things to look out for. You've got to get it surveyed and make sure it's the right thing. Financing, of course, is very important. I'm pleased to say now that we work with a very, very good UK registered and domiciled mortgage broker that works particularly with people offshore from different parts of the world. And so they're able to look at pre-approvals very quickly and get a very quick idea of what you can go for and what you can't go for. And of course, insurance is another big one. Something that a lot of people don't realize is that the UK actually has landlord's insurance to protect you if your tenants don't pay. It's not universal yet, but it's there and it can be availed of. So it's important to look for those things, because obviously with property, you want to make sure that you're getting stable, steady returns, because that's paying your mortgage off and your financing, but also it may be more critically funding retirement for yourself, or funding education fees for your children and things like that. Something that's become very, very big in the last few years, as people hear about other people that own properties, not just in the UK, but particularly in the UK, is that you go and buy a property, you own it, perhaps you've got a manager, but you have problems collecting the rent from the tenants. The tenant doesn't treat the property with respect. You've got to do more due diligence and vetting of a tenant and things like that. And this is especially common when you're looking at certain areas of the market where the returns can be quite lucrative, but to put it frankly, where the entry level is perhaps a bit lower. Glad to say there are solutions to this now. There are a number of companies in the UK that specialize in making the whole process completely seamless. And what they do, if you've got somewhere between 80 and 120,000 sterling, is you can pick up properties which they have renovated or redeveloped in areas which are being redeveloped themselves, whole communities and neighborhoods, and they tend to be either social housing or for people that are refugees or people who are disabled and things like that. There's a social element to these types of housing typically, but the contract is not with the tenant. The contract is with the local authorities. And what that means is that you're guaranteed by the government a 10-year contract for the particular property at a fixed rate. And best of all, the rates tend to be inflation linked. So you might start 1 year at 8% as your return, and then it goes up to 9 and 10 and so on, depending on what the consumer price index is. So this is becoming quite popular. The only downside is most of these properties fall under the radar of financing. So you do need a little bit more to get in. But if you compared that with, say, a London property at 300,000-400,000, you're going to have to find about 80,000 anyway to get in. So it's almost the same thing, except in this case, you're guaranteed inflation-linked returns for a decade or more, paid by the government. They're also responsible for the upkeep of the property, the insurance of the property, and everything else. We can't talk about the UK without talking about tax, of course. I'll quickly run through the 3 taxes you need to be aware of. I won't go into the details of what those taxes are. It's always important when you're considering property to speak to a qualified tax advisor and make sure they're advising you throughout the whole process. So the first tax you've got to be concerned about is stamp duty. However, this is only really a concern if you're buying a property that's worth more than 250,000 sterling. And only about 2/3 of the market is above that level. The rest is below. So naturally, we see a lot of people buying properties at 150 to 249,000, etc. So they can avoid that altogether. If you're looking at alternative financing, such as Sharia, for example, you may be able to get some exemptions on stamp duty. And first-time buyers can get an exemption as well, which is slightly higher. That's to help new people get into the market, especially younger people who've got families. Non-resident buyers do pay slightly higher rates now, but again, this only applies with the 250 mark onwards. So the next thing you need to worry about, of course, is your rental income tax. So you are subject to it as a non-resident, and you will need to make sure that you're properly advised on that. But any good property management firm or lettings agent will be able to advise you on that, and also file this on your return, on your behalf to the UK government. So the letting agents normally will typically hold 20% back, and at the end of each year, you get that back with any deductions that might be applicable. People who've got lots of properties in the UK and built up portfolios, even when they own companies, will still be paying tax, but it's minimized quite substantially. And then, of course, the last one to worry about is capital gains tax. Now, this really only applies when you sell the property. I always say treat property like you would treat stocks and shares. Don't buy anything that you wouldn't be comfortable holding for 10 years if you were barred from selling it. If you don't think you could bear to hold on to something, don't get involved in it. Look for something else. And so capital gains only applies to that. It only applies to the profits that you make. And there's actually a matrix which you can see online. But again, better to speak to a tax consultant, which gives you the calculations based on residency, the price you paid versus sold, and even previous properties and losses or gains you may have made. So in conclusion, the UK remains an attractive destination for international investors to diversify their portfolios by jurisdiction and by currency. It continues to have some of the strongest supply and demand issues in Europe, and there are options that suit both long and short-term investors, and as you've seen, even for entry levels at a much lower level. For example, the loan notes started around 25,000 sterling, which is substantially less than buying property outright. So with options to suit both long and short-term investors, it's a good time to explore in more detail. Please reach out to me if you'd like to have a deeper conversation and see if we can find something that suits particularly what you're looking for. And with that, I'd like to thank you for your time today. A very quick presentation, and I'll open the floor to questions, answers, and comments. Thank you.